we've done a lot of work around the resources space and with the Perennial team here. We'll be hearing from Ewan and Sam to talk about the sector and the opportunities in that area. But the reason why we really, really like it is we do think we're in the early stages of what I consider the run commodity and resources. And another area where we think the downside is rather limited, but there's considerable upside. You know, we've been through a period where there's been a massive underinvestment in this space, but demand is now going higher and higher. And you've got a great way to touch into things like AI, energy transition, and a lot of these thematics that might be a little bit stretched in valuation. This is a much more reliable way to tap into that and also sharing some of the upside and the gains. We always enjoy partnering up with what we think are best of breed managers, and I think the numbers and also the insights from the Perennial guys to be able to share will give you the confidence around that for sure. Highly specialised area, also good to complement our ability and our exposures with their team and their insights in the market, which I will say are well and more advanced than ours. And so hence the value of including that with regards to our overall strategy. What we've been kind of using this is about a 10 to 15% allocation within our Australian share equity allocation as part of our portfolios. And the other benefit of it is sometimes resources can be quite cyclical and a little bit volatile, but we've done a lot of work in the fund, and it's actually a good bit of counterbalance towards the rest of the market, where it actually helps smooth things out, but give you a better upside and more growth. So a number of measures there in the work that we've done about how we complement that in there. And I think, again, tapping into the team, myself, Ed, Peter, and the rest of the guys, that structure's enabled us to really do a lot more work, find these guys, team up with them. We've definitely been early with them and ahead of the curve. I dare say that there'll be a lot more people trying to come on board in the near future, given the success they've had and the opportunity in the space. I'll leave it there. I'll hand over to you guys to do a bit of an intro into the fund and then take it from there and go for it.
No worries. Thanks very much for the opportunity. I'm just checking you can all hear me okay over there in Sydney.
Good, yep. Thanks.
Rightio. Who's controlling the slides there, just so I'm aware?
Yeah, I can. Sorry.
Rightio. So, my understanding is, there's obviously, we've spoken to Shaw's quite a few times, so I'm sure there's a few people familiar with the fund, but my understanding is that there's a few new faces in the room that might not have seen this product before. It has been going reasonably well over it's just under 6 years that we've been traveling, sitting on around about 33% per annum over that period. That return has been achieved with a relatively low level of volatility. So if you wouldn't mind ticking on to the next slide, we did have a bit of a flat spot there through sort of mid-22 to mid-23 when central banks around the world were hiking rates aggressively for the express reason of smothering demand to combat inflation. But outside of that, it's been a reasonably steady sort of ride from the bottom left to the top right. Obviously with a bit of an exceptional return in the month of September where we did 16%, which was just one of those lucky months where about I think half a dozen different stocks had quite material catalysts all happened to come in the 1 month, which is all what you always hope for, but it very rarely happens that way. It's normally much more steady. But I think after this period, after that last couple of months, the challenge is to make sure we hang on to that performance and don't give it back. And I think that's probably one of the points of difference of this fund compared to some of the others. Actually, maybe skip past that one, Ewan, on to the next spot. I'll just spend a couple of minutes on this. I appreciate a lot of you would have heard it before, but just for any for new comers to the fund, the whole purpose of this exposure is to provide, or this trust is to provide investors with exposure to the commodity space, capturing as much alpha as we can, but minimizing that beta. Because if you look across the universe of resources funds, one thing that does stand out amongst most of them is that there are periods of euphoric performance, but they've got a nasty habit of handing most of it back. So we just want to dial that volatility down as much as possible. And there's 3 points of difference with this trust versus peers and how we achieve that. First of all, we do invest in physical commodities, which we love because there's no operational risk, balance sheet risk, dodgy governance risk, etc., etc. but you still get the exposure to the same underlying thematics. So, same sort of driver of the alpha, albeit with less beta. We also invest in industrials which facilitate the activity of commodity production. Those are, otherwise known as the services sector. That doesn't necessarily mean earth moving. We try and focus on more energy or mining tech type exposures, and two examples of which of Doug Technology and Southern Cross Electrical, where those two photos are from in the middle there. And the last one, which is a little bit counterintuitive, is that we are long only, and we opted for a long only structure, which mightn't seem to go well with a cyclical sector like commodities, is because in our analysis, it seems that funds that veer away from the stock selection and start indulging in financial engineering with sort of derivatives or gearing the portfolio or even going long short, all those factors seem to increase beta to the portfolio, which we don't want. So, when we can't see a decent return on a risk-weighted basis, we run to cash. And the outcome of that structure is, best captured in the slide in front of you, which shows the 28 negative months for the ASX 200 since this trust has been up and running. They're in grey, all down the bottom there. And then alongside each one of those grey months is how we've performed in purple. So sure, we don't achieve a positive return in every negative month, but in aggregate, our returns of negative 8.5 versus the index at negative 96.6 just shows that our downside capture has been pretty good, despite being a long only portfolio. So I think we've been reasonably successful in achieving our aim, which is reducing the beta for investors in this trust, whilst capturing as much as the alpha as we can from the opportunities that do throw up or do get presented in the commodity space. And it is a very inefficient sector. So those opportunities come along quite regularly. So I'll just pause there for any questions on that before we move on to probably the more interesting stuff, which is the forward-looking bits and pieces. No, all good. Rightio. So, just I suppose commodities investing in commodities is a top-down exercise. You need to get the commodity price right if you want your equity to outperform. So that is that starts with the macro. More broadly speaking, the wobbles that we had from the trade war at the beginning of the calendar year have all sort of receded. The headlines now, as they pop out every now and again, don't make markets jump the way they used to, because I think people have come to an understanding that there's always a deal on offer, and the headlines are sort of diluted quite a bit, so the markets aren't being scared. But certainly they did have an impact. So GDP growth for the first half of calendar 25 was down quite materially for both US and China, as they were wrangling with their tariff wars, compared to the rest of the world. But that's the base that we're coming off now. Now deep into the second half of the calendar year, we've had interest rate cuts at our back, and as well as other sort of government stimulus that's trying to counter the effect of those tariffs, and obviously high, and coming out of an environment of higher interest rates. So if we look over to the next slide, there have not been the winners and losers have not been have been quite diverse. So from a commodity strategy point of view, this chart on the left-hand side there is all important. If you're exposed to property sectors or traditional fixed asset investment, things have been pretty dull, and you can see steel demand domestic output in China on year has been negative, reflective of that downtrend in fixed asset investment. What has been working better is commodities exposed to your manufacturing, exports, and retail sales. So that means consumer electronics, green energy exposures, electric vehicle exposures, and all the metals that go into those products. So you can see those on the right-hand side. Actually, lithium's even having a bit of a flutter recently, but copper, zinc, aluminium, generally speaking, your base metals have been doing a bit better. And the reason, some of the, I suppose, in acknowledgement of the fact that we are coming off a lower base, stimulus did start to tick up, towards the end of the first half of calendar 25. Chinese bond issuance was strengthening, and we certainly saw the credit impulse starting to tick up as well. And that's leading to an improvement in sentiment among commodity companies, the steel producers, etc. And it is leading to a bit of I suppose, a restock of some of those base metals, particularly the ones which future supply, also where supply has been impacted, and foremost amongst those is copper. So if you tick over again, you can see the Purchasing Managers Index globally, which is a lead indicator for commodity demand, has been ever so slowly getting itself up off the floor post the central banks around the world hiking rates aggressively, and through that period from sort of late 22 through to where we are today, the copper price has ground higher, hitting all-time highs on the 29th of October. But I think the other point worth dwelling on this slide is just where PMIs are relative to the last 20 years. So it's hardly a euphoric environment for commodity demand. This upside has been driven by more, I suppose, supply side dynamics, but also perhaps a little bit of anticipation of tightness over the years ahead. But yeah, sorry, I suppose a bit of hand over to you, and there might be able to get a little bit more color on some of those misses that those producers have had recently.
Yeah, Sam said, when you look at sort of like the historical, the current PMI data compared to the past couple of decades, it's not exactly sort of a risk-on environment at the moment. That demand is still pretty soft, like Chinese copper growth on the demand side has been sort of 1.5%, pushing up just around that this year. What's really pushed the copper price up this year is supply side cuts. So the chart on the left sort of highlights over the past few quarters, we've had numerous instances where I think at 5 of the world's 10 largest mines, there have been material downgrades to production. And that's a mixture of like Grasberg. There was obviously the seismic activity. You've had the similar at Kukua. There's been mudslides. Codelco's going through sort of decades of underinvestment. So you sort of look at Grasberg, which is the world's second largest mine. El Teniente's had problems. QB2, which is Teck, and Collahuasi, which is the Anglo-American mine, which are being tied up together as part of that M&A deal. Those ramp-ups have had serious issues. And now you've had a situation where a few 100,000 tons are being taken out of the market for next year. And it doesn't sound like much in the scheme of the copper market, where it's sort of like around 26 million tons a year. But from our end, normally 0.5% to 1% swing in production is pretty material and is enough to push the market into deficit. However, it's not just the supply side and the production side that's really struggling as well. There are other geopolitical risks to the copper market. And I think the chart point on the right highlights this. So everyone, when they think about copper, thinks about Chile, which is still the dominant producer globally. But over the past 15 years or so, you've had the rise of African production, most notably out of Zambia and the appropriately named DRC. Now, where this is coming to a risk is this, and this shows how fast things move. We did this deck probably about 3.5 weeks ago. The port of Dar es Salaam was closed due to election unrest. That's only recently reopened again, but this was another quirk that was sort of pushing prices higher because 2/3 of African copper production, which is 16% of global production, goes out of that port. And that was really struggling to get free because there wasn't space anywhere else. I think that highlights how while demand has been pretty soft, the world's beginning to wake up to the fact that actually the supply side isn't plentiful. You can't just flick a switch to bring it online. And that's where we're seeing prices begin to react. And I think anecdotally, we've joined some calls recently where if you'd spoken to sort of Chinese buyers at the beginning of the year, they'd have sat there and gone, yeah, when the price dips now down to sort of like $9,000 a ton for copper, that's where we'll start having a nibble. And you've seen that level slowly inch up higher and higher to now where they're going, actually 10,000 is what we'll need to secure that offtake, because ultimately we think the scarcity of supply isn't something that's going to be changed anytime soon. I think I'd also finally add that when you look at those supply side downgrades, these aren't sort of one-offs. These are multi-year changes to the life of those mine plans, where suddenly you're going, okay, if you're assuming that someone like Kamoa-Kakula is going to do 750 to 800,000 tons a year, actually that might turn out to be 700 or maybe even 675. So that's where we're sort of waiting for those updates. But that highlights the problem that we have, as sort of like demand eventually is going to come through from the likes of AI.
Flicking back from China and more focusing on the US, and I think this is going to be, this commodity boom is going to be a little bit different to the next one from the last one. Sorry, where obviously the China demand was all important for the commodity boom 1.0, but there's certainly many echoes of the 70s commodity boom in the the sort of geopolitical outlook and positioning that we've got at the moment. But with that in mind, important to note as we go into 26 that the Trump's budget took effect from October, so they're going from a net restrictive to a net stimulatory budgetary position, which will again be good for demand. But unfortunately for the US, all their spending is still being funded out of debt. So in a roundabout way, similar but different to the 70s, is that the US government at the moment is actually selling treasuries to buy commodities, and we've seen them with rare earths. We've also seen it with taking positions in, having options on positions in companies like Westinghouse in nuclear. And I think we're going to see, the US has actually been quite clear that we will see a broadening of their critical mineral support in order to shore up their commodity requirements that fall under the national security umbrella. So that debt funding, I think debt funding of the US is going to continue, but it does undermine the value of US dollars and does increase the appeal of hard assets like commodities.
Moving on, obviously something that's been a fair bit in the news recently. I mean, even last night you watched Nvidia get smacked around a little bit. But what's been fascinating is with this whole rise of AI is you think about that allocation of capital over the past sort of 15, maybe 20 years. It's swung from, like Sam said, hard assets and resources to capital light and tech. And you saw a situation where if you look at those the columns on the left, you can see that difference from that sort of capex to sales to R&D sales model from 2015 to today. And the sort of big tech names, particularly the big four, are really swinging to a very hard asset model as they try and sort of like gain supremacy in the AI race. And I think you can go back and forth on the ultimate economics and the returns on these projects. But for us as resource investors, we're seeing the rubber hit the road today. So those data centers are being built. They're very metals intensive. And in turn, that power demand is coming through. Where it's fascinating in this ramp up is in 2025, so this year, the big four tech names between them are going to spend more than the entire global mining and energy complex. So just around $400 billion. If you want to drill down onto, I guess, a level that probably hits harder home within Australia, BHP and Rio, the world's two largest miners, are going to spend around $11 billion in capex on their global portfolios this year. Amazon, Meta are going to spend more than that on one data center. And where this is coming through on the metal side is previously, like one rack of AI GPUs uses the same power intensity of 10 to 15 traditional ones. And that metal intensity is really ramping up to the point now where, for example, the likes of copper, just with the data center alone, could be probably 6 to 8% of your total capex figure. However, something that gets lost in all the noise with big tech, or I guess taking all the oxygen in the room, is there are other areas which are also becoming more and more metals intensive. Now, obviously, we all follow the news. We've seen President Trump's been pretty vocal on his disdain for NATO members and their failure to hit that sort of 2% of GDP cap on defense spending. Now, currently, metals demand, like from the defense side, is around 3% of global demand already. The EU's already committed to going from sort of 1.8, 1.9% of GDP to 2.7 by 2027. Where this really comes in is you're going to see a 0.8% and a 0.6% increase in copper and aluminium. And as I mentioned earlier, sort of a 1% swing in these markets is very, very material, because if you put it in perspective, to bring a mine on that's sort of 250, 260,000 tons is not something that happens every day. So suddenly you've got a situation where you've got cashed up big tech, where free cash flow means that they can cover this capex increase in the blink of an eye, but then also governments who are more than happy to issue paper to try and meet that demand as well. And then on top of that, everyone focuses very much on sort of the generation capacity. But if you look at every country where they're having to replace that generation portfolio and work out what does that new utility mix look like, the poles and wires is another area where they're falling over themselves left, right, and centre. Prime example in Spain, obviously, there was the blackouts post how the renewables are set up in the grid. But that just exacerbated the fact that Europe needs to replace around 40% of their poles and wires because they're 40 to 50 years old. And there's a metal intensity that comes with that the supply side, I think, is really, really going to struggle to meet. Where we're seeing this demand be reshaped at the moment is traditional sectors for copper. You'd have sat there and gone like construction, white goods, some of the car side of things. That was around 90, 92% of demand coming through. As we're looking over the next few decades, you're going to see new areas of economy, so EV, robotics, the internet of things, AI, all those sort of things that come through and account for around 30% of demand. Where this is coming through most starkly is you look at the chart for data center demand and what it was placing on copper. Pre-AI, around 80,000 tons in 2020, traditional cloud computing data centers. That ramped up to 260 by 2025, and now it's been forecast to be 650 by 2030. However, this chart doesn't tell the whole story, where everyone is obviously being pushed around, especially I guess in Europe, around the growth of EVs. That ramp up hasn't occurred as quickly as expected, but even now today, copper demand from EVs is 1.2 million tons, and that's forecast to grow to 2.2 million tons over this same time frame. It's not just the metals intensity, though. I'll tee it up for Sam, because I know this is something he's very passionate about. But when we look at getting that end product, in this regard, it'll be the aluminium and the refined copper. Power is so critical to those processes running smoothly. They currently account for around 30 to 40% of your OPEX costs. And you're seeing a situation now where aluminium smelters in particular need pretty low, stable price environments to justify their running costs. We're seeing that flare up at the moment with Tomago, where they're going back and forth with the government over the increase in price from, I think it's around $60 a megawatt hour to around 150 under standard commercial terms, and that's going to need to be subsidized. But most aluminium smelters would need sort of like 40, maybe $50 a megawatt hour. You've got big tech coming over the top going, well, for us, the power is something we're not really fussed about, because we're viewing this as sort of an existential race for our own existence. So we're happy to pay $100 a megawatt hour, and sort of you're biting the hand that feeds you. In turn, though, you have a situation where if power bills keep creeping up and these industrial processes keep getting squeezed out, it has a very real material economic impact. And I'm sure Sam's going to touch on that in the next couple of slides.
Yeah, thanks. There's actually even a bit of headline on that very point yesterday with Linus cracking the shits that the Western Power was doing a woeful job in supplying, reliable power to their facility in Kalgoorlie, and so now they're going to opt to go down the path of producing their own power, which my understanding is that they can do that for around about between $130 and $150 per megawatt hour. So I think Linus's facility, because it's they've got high grades, they can absorb that cost without too much of a problem. Unlike Tomago, which is a bit more power intensive, but it highlights the risk that we're facing in this country of more and more large industrial users moving away from the grid and producing their own power. Now, if that was to happen, intuitively you think, well, hang on, there's less demand, therefore prices should fall. That's not how power prices work, because you've got such a large fixed cost base of all your poles and wires, your transformers, and all your distribution network. If you have less kilowatt hours running down the line, the cost per kilowatt hour actually increases because the costs remain the same. So it is a concern, and it's a thematic that we're going to I think, experience more and more of, or come to terms with as the years go on. But right here, right now, power price volatility is bad enough, and that's what that slide is all about. You can see, over 10 years, what's happened to power prices throughout the day in various seasons. We've gone from having, very flat and boring power prices to having a very volatile and peaky power prices between sort of 2010 to 2023. But it's not just a 10-year type thematic. In the top right there, that's a year-on-year comparison of the power price volatility in the June quarter. So you can see, even on a year-on-year basis, those prices are spiking, or price spikes are becoming, more material. And the reason it's happening is because we've removed quite a lot of dispatchable generation from the market. So our big coal power stations have been shutting down for a while. A lot of them have exited, and they've been replaced with intermittent generation. So that's the intermittent generation in dark blue there. And that's basically all we've been building for the last 10 years. And because you can't rely on that generation to be available in the evenings when power demand peaks, that's what's causing volatility. So the business opportunity here is for businesses that can dispatch power reliably into those peak demand periods, and that's a structural opportunity that we'll touch on down in due course. But something that's a little bit sexier and certainly front of mind at the moment is our rare earths exposure. Unfortunately, it's not my screen that you're looking at the moment. But if it was, I'd pull up the price for these humanoid robots in the top right-hand corner there. That's the G1 model from Unitree. So I've been tracking the price point of these things for a bit over a year. Back in September of last year, those were retailing for about 90 grand. In April of this year, they were down to 40 grand. I think about June, they hit 16 grand, and they've been at $16,000 for a long time. But I just looked at the website earlier this month doing this exact presentation, and the price has dropped another 15% to $13,500. So, you've had, what's that, about an 80% fall in price in 12 months, whilst the functionality of these robots is getting better and better and better. So these things are going to find more and more applications in industry, in commerce, and in the home, I think, reasonably rapidly. And so that means that middle chart, which is indicative of what the big banks are assuming for the rollout of humanoid robots, that starts in that inflection point there is in the early 2040s. That whole slope needs to move to the left by about 15 years. This inflection point is happening now. Growth of industrial robots is going exponential, and there is no metal more sensitive to the expansion of these robots than neodymium and praseodymium, being your two value drivers of your rare earth deposits. And you can see the sensitivity there in green in the chart on the bottom left. But if we tick over to the next chart, I mean, I've put this table together to highlight the difference in sort of the way that we look at assessing deposits, and it sort of strikes me as an area of acute inefficiency at the market when you see all these rare earth wannabes rallying quite strongly on the back of this thematic, despite the fact their deposits are incredibly low grade. So, for example, I'm not picking on anyone in particular, but I've just chose a sort of a hypothetical rare earth project which has a grade of 2000 ppm or 0.2%. If you multiply that through the basket price of rare earths, which obviously isn't just your neodymium and praseodymium, it includes all the lower priced shitty ones as well. Multiply that through by price, then by recovery, and then by the payability, you get a recoverable payable metal per ton of ore value of about $43 per ton. So that is the value that you need to deduct your mining cost, your processing cost, your any transport costs and admin and all the other crap that gets stacked on top. It leaves bugger all by way of margin, as far as I can see. Conversely, a more traditional, I suppose, rare earth project which measures their grade in percent rather than parts per million. And I've picked a grade of 4%, which is roughly in line with Arafura's deposit. We're not a holder of that, I must say, but I think that's they've got some other challenges, but whatever. It does have a reasonable grade of rare earths, and then you apply the same calculation, multiply through by price per ton, less and recovery and payability, and you get a payable metal per ton of ore of about $864. So you can see that the scope or the to be able to cover your mining processing costs, even if they are a bit more expensive, is materially increased. So just this comparison, I think, is worth keeping in mind if you guys are assessing rare earth projects that come across your desk.
Moving, still staying within the energy thematic. So as we sort of chart lays out, so that growing electricity demand is driving gas turbine orders, and sort of what initially sparked this was you've got the chart on the left pointing out that sort of potentially by 2030 around 4 to 4.5% of global electricity demand is going to come from AI data centers. Where we've been able to take advantage of this and do pretty well, the trust over the past year or so, is via the gas turbine manufacturers, two in particular, GE Vernova and Siemens Energy. Now, we've sort of been following these for about a year and a half, maybe 2 years, where they got themselves into a fair bit of trouble, blown themselves up going into offshore wind, where I don't know how many of you follow, but Ørsted recently had to do a rights issue at an 80% discount. Got recapitalized, got spun out, and so they've begun to benefit from the fact that as big tech began to sit there and go, okay, we need to power these data centers, whether it's in front of or behind the meter, they were looking for the sort of generation source that was most abundant. And in the US, that's natural gas. So gas is already the dominant generation provider in the US. And crucially, via the shale revolution and the growth of their own LNG, there's an abundance of it. There's existing infrastructure. It's easy to tie in and tap in and power your own sensors. And these two names in particular being the beneficiaries. I mean, ultimately, the market's an oligopoly, including Mitsubishi as well, who are probably a bit more focused on Southeast Asia. But Siemens and GE have benefited from the fact that no one else bothered dealing with gas turbines because the likes of the IEA said that we were at sort of peak fossil fuel production. And they kept on refining those gas turbines, building out that entire value chain, which is where they dominate it now. And you have a situation where those order books have exploded over the past couple of years, or the past year in particular. They've upgraded guidance twice this year for GE Vernova. Siemens did it recently at their Capital Markets Day. GE Vernova has another one coming up. But the outcome is that if you want to order a gas turbine today, you're going to have to wait till probably 2029, more like 2030 to get your hands on that. Not only that, but the price of those gas turbines keeps pushing up. So pleasingly from our end, when we're looking at sort of the companies and the capitalists and the moats that we want to see, both those names in particular have pointed out how not only is that order book growing pretty exponentially, but in turn, the price per megawatt for those gas turbines continues to rise. So if you think about someone like Siemens Energy, they came out at their recent Capital Markets Day and said, look, that profit margin before special items was around, let's say, 9% for 2024. And they just increased their guidance for 2028 by 21% to 18 to 20%. So I think that shows you the scale of the demand coming through and where these guys were the beneficiary.
Thanks, Ewan. At the smaller end of the market, but touching on the very same thematic or the similar thematic, this is another stock we're interested in or been following for a while called QPM Energy. Particularly in light of the success of, I think it's LGI, that waste gas, sort of waste gas capture and power generation company, which has done quite well. I think QPM offers exposure to the same thematic at a cheaper price. And it also includes a very interesting anecdote, which I think highlights how rooted Australia's power network is. So, following on from Ewan's point about how there's a shortage of gas turbines globally, and Australia in particular has very volatile power prices which support gas peaking projects. there was a private equity group called Quinbrook that saw this coming from a ways off. They went and secured 2 gas turbines off Siemens, which they were looking to put to work somewhere on the east coast. And then they went looking around for gas. But because we've got a gas shortage in Australia, they could not, for love nor money, secure an adequate gas offtake to make that business work. So as the clock ticked down for making the final payment to Siemens, they were forced to sell those turbines, which QPM Energy picked up at a price, 30% below what you'd be paying today if you wanted the same thing. So just in terms of the moat that exists around this gas peaking or dispatchable energy business model, requires basically 2 things. You need gas and you need turbines. Well, on the East Coast, there is no spare gas. And if you want turbines, you've got to wait 5 years. So I think these guys are quite strategically well positioned in securing the assets that they have. They still need to raise the development capital to put that all together. But I think that process is not far from getting underway, and at which point you're going to have quite a unique business model outside of the large utilities. And I suspect that QPM will probably end up inside one of the large utilities in due course. But these are a few thematics that we look at that aren't your typical, straightforward commodity stories that require rising commodity prices. These are things that we've happened across through, analysis of energy networks and diving into this energy transition, which a lot of commodity funds were talking about as a big driver of their returns maybe 2 or 3 years ago. The story is evolving, and as that happens, there are more and more opportunities, not least of which is in uranium. But we might talk about that one a little bit later. Moving on to gold, though, if we sort of skip through to page 26, I'm sure you guys read bucket loads on this stuff, but so I won't dwell on this for too long. But we've got 20% of the portfolio in gold at the moment, which is our largest individual commodity exposure. What are we looking for to as a trigger or as a lead indicator to wind that back? And it is on the chart on the left-hand side here, and it's the we're looking for a structural improvement in US government deficits, which might be a bit faint at the back of the room, but 2025 there is in purple, which is the worst it's ever been outside of the 2 COVID years, 2020 and 2021. So we'll see if Trump's tariffs work their magic and manage to balance the books. I think it might be a bit tough, but and central banks around the world seem to being agreeing or taking a similar view, because they're drifting away from US Treasuries and towards gold. And actually, Ewan, might be worth just highlighting that it's not just the central banks that are moving towards gold; it's the crypto universe as well.
Yeah, I think on top of this chart, one of the fascinating developments is being that Tether have their own stablecoin USDT, which is asset backed 1-for-1 by US dollar denominated assets. They've been buying US Treasuries, so they've recently announced they're the 17th largest holder of US Treasuries ahead of South Korea. Also, they've been building up a gold position to back it as well. So they currently have, I think, you have to be a bit careful because they haven't subjected themselves to the same audits that everyone else does, but they've got about 116 tons of gold locked away in various vaults, and they're looking to keep building that position higher and higher. So you've got a situation where you've got sort of what's meant to be a decentralized asset being physically backed by the world's oldest reserve currency, which is pretty fascinating. But it's also telling that when you look through the consistent commentary from all these crypto funds, they're seeing value in terms of being able to tie their asset base to a physical asset like gold.
Yeah, and a couple of gold stocks on the next slide, and this is a new slide, so not a lot of people have seen this, and these are some quite small companies that I've listed here, but they're interesting because of the way they're priced. So I suppose the context behind this is that rising gold price increases margins, so all your mid cap and large cap stocks go up quite materially. But um, because gold has risen so far over the last sort of 2 to 3 years, it's reduced the payback period for building new mines materially. So just recently we saw Rox Resources, which I've mentioned earlier. They secured their development capital. That is a project which 3 or 4 years ago had a payback period of maybe 3.5 years, whereas today at spot prices that payback period is less than 12 months. So these projects are getting financed and they will go into production. So in looking around for opportunities, rather than taking exploration risk, which I don't like or we don't do, I think it's much more appealing from a risk reward point of view to identify some of these resources which have been around for, maybe 5 or 10 years or more, but they've been locked up in private companies and haven't been allowed to re-rate, I suppose, with the in line with the gold price. And one of those is PC Gold, ticker is PC2. This IPO'd just last month, but it was in the second half of October after the gold price had shat itself. So it had a pretty ordinary IPO performance, and it's also been a private company for quite a long time. I think since 2016. So there's a big sort of tail of stale shareholders that have had their money tied up in a private company for a long time. I suspect some of that's drifting out, but they've got they've got the best part of 1 million ounces here. Existing resources 820,000 ounces. There is line of sight of that going to 1 million ounces. It might be difficult to see up on the screen, but if you get this in soft copy, you can or look up their own presentation on their website. This deposit is mineralized from surface. It has a strip ratio of 3.4 to 1, and it's located about 26 kilometres away from Agnico Eagle's Union Reefs mill, which is, I think it's about 2.5 million tonnes capacity and is sitting idle doing bugger all. So, there's no guarantee at all of a deal between those two, but clearly there is an opportunity there to, start running a bit of this feed through that mill, and back of the envelope suggests maybe 80,000 ounces of production if you were to do that, which at current prices will spin off circa $200 million worth of EBITDA. Now that is an hypothetical and it is an arm wave, but it does highlight, I think, the potential of a project which, when the board acquired this asset, at a 1 gram per ton ore body, that was worth about $56 per ton in terms of contained gold, where the gold price is where today, it's about $193 per ton of contained gold. So clearly your mining and processing costs are easily covered there, and it offers a pretty decent margin for a Australian-based large open pit development proposition. The other one, which it doesn't sit within the Strategic Resources Trust, this sits in the Micro Resources Trust because it's just a little bit smaller still, but a very similar story. These guys are Sentinel Metals, ticker is SNM. They have a best part of 1 million ounces in Montana in the Columbia project. Again, mineralized from surface. Again, low strip ratio. And for whatever reason, this thing IPO'd with a ridiculously low market cap. It was 20 million with 10 million of cash, so an EV of 10 million bucks. This one has done a bit better. It's re-rated. It's trading, I think, mid-30s today. But the development or the hurdles for economic viability here look incredibly low based on what they've already got. You do need to come to terms with permitting processes in Montana, which is where Sandfire's Black Butte project is. That has been problematic to permit, but that path to permitting is getting much, much easier under Trump's administration, and specifically Montana as well. The permitting process has sped up materially over the last 12 months or so. So I suspect you'd probably see this project permitted ahead or faster than an equivalent project located in Australia. So yeah, I highlight these two projects, even though they are quite small, and will only ever be sort of tiny bits or start off as tiny bits in the portfolio. But this is how inefficient I think the bottom end of the resources sector can be. But don't take my word for it. You guys are more than capable of getting these companies in and having a listen and making your mind up for yourselves. So I suppose it's bringing us back to the probably to the end of the formal part of the presentation. I'm not sure. Do you have slide 37 in the deck there? If we tick through some of the supply stuff and just do a bit of a catch-all here. So this chart, I'm sure you've seen before. Every resources fund and their dog wheels it out to say, "Oh, look at that! The line's got to tick up." What this line is the Goldman Sachs Commodity Index divided by the S&P 500. You can see from the 2012 or so, the end of the last commodity boom, capital has moved away from the commodity space primarily towards big tech. But as Ewan's pointed out, now commodities, both through the metals for the data center construction and the energy required to run those data centers, is standing as an impediment to big tech's ambitions. And big tech is well funded and they're impatient. So if commodity prices need to go up for them to get what they want, that's exactly what will happen. What will also happen is at the same time, you've got this, geopolitical competition for commodities or critical minerals, as we've seen play out with rare earths, where the US is underwriting or has underwritten rare earth prices at $110 a kilo to spur production growth of those and ensure their supply chains are immune from China. This does have echoes of the 1970s commodity boom, which actually went on for the similar period of time to the China boom, but with sort of slightly different drivers. But I won't sort of dig into those today. But needless to say, if a superpower wants commodity prices to be higher, that's probably what's going to happen. So we do have some strong drivers there to push an inflection point in that line and see a reallocation of capital towards the commodity space. And I think a lot of those drivers are structural and largely independent of the global macro environment and global growth in general, which is a little bit soft, but does seem to be strengthening as we move into 2026. So with that, I might pause and see if we've got any questions.
I got a question. Just on the copper theme. So with this AI capex and the build out, I'm starting to hearing rumblings about, I don't know, town XYZ in the US has a data center, so their power bills are going up threefold, and you've got the midterms coming up next year. Is it possible that this becomes a bit political? And because I'm trying to think of like you had me at hello with commodities, like I'm massively bullish and the rest of it. I'm just trying to think about what could derail it, because the copper to me seems like it should go a lot higher. But like, is that bullish scenario that you painted for copper, is that priced in, do you think? Like, and if suddenly the capex suddenly got wound back because of whatever reason, do we see the arse fall out of this stuff?
I don't think we see it fall out probably for the next year or two at least, because the tech names already come out and reiterated that spend for the next 18 to 24 months. I think the power thing is an interesting one because we do have some of the US utility names, and you look at sort of ERCOT, which is Texas, and PJM, which is that Eastern Seaboard, which are the big electricity markets exposed to data. Those prices are taking huge leaps up, which are in turn being passed on to sort of like your average consumer. I think there's probably going to be a political push to force the data centers to not be connected to the grid, because this has been a lot of the back and forth that they want the power, they want the reliability, but they want it to themselves. Then if something goes wrong, they want to be able to tap the grid as well. So there's probably going to be more rumblings over how that setup looks.
So what's that, SMRs and stuff like that? Is that nuclear?
No, it's building gas power generation just on site. I mean, you can, if any of you are subscribed to the Financial Times, they've done great series where you can go and look at sort of a portion of the Arizona desert that was empty a year and a half ago, and suddenly 15 acres is being taken up by data centers. They built a power station, they built the pipeline infrastructure seemingly overnight. And I think that is probably the way it goes to try and ward off some of that political interference over the average person's power bills going up. On the copper price side, I don't think it's priced in at the moment. I think the initial shock you've seen has been the supply side,
Right.
where that's been taken out, and we're still waiting to see what that long-term impact will be. If you begin to see demand come through, and I think China data that came out recently on that FAI spending was pretty weak. If that stimulus package comes through, and then you begin to see sort of the US and Europe really recover, then the squeeze on the copper price, aluminium price, a lot of these metals is really going to come through. And I think that's been underestimated. And in turn, that's why you've seen copper hold its level at sort of 475, 480 a pound, because the Chinese have been sat there filling up their own domestic inventory coming through. I think Sam would, when we talked internally, Meta was talking about building a Hyperion data center, which is 5 gigawatts, and potentially the copper demand, and these numbers are always floating around, that could be sort of like 1.4 to 1.5% of copper demand for the year for one monstrous data center that built out over those years. So I don't think it's going to change anytime soon. And I think what's actually happening is the market is underestimating the ability of the supply side to respond to new demand drivers coming through.
And so 20% of your fund is in gold today. Like for 2026, is copper the thing you're most bullish about? Or like which commodity are you most bullish about 2026?
We're bullish on copper, but I think it's obviously going to be volatile. And the other problem that this copper's had as well is you can be bullish on copper, but you sit there and go, so Freeport, Ivanhoe, First Quantum, Codelco, Teck, Anglo, all these big copper names have all had production downgrades where that supersedes what's going on with the copper price. If you come out and say, yeah, we're going to have to slash production by 200,000, 300,000 tons, your share price is dropping 25%, and it might recover over time, but it's a little bit harder. I think there's probably gold is a bit of a safer one because those macro drivers are a lot clearer to get your head around, and I think we've probably got greater certainty in those coming through and the impact on the price at the end.
Are there any Aussie copper names that you look at?
Capstone Copper is probably the big one. On our end, I think they've come over here. They were originally listed in Toronto, and they've come over to Australia with the CDI. What I think we like about them, and I think the market sort of ignored for a while, we've held them for a few years and traded it around, but they've sort of been a mishmash of tier 2, tier 3 assets coming together. Why we like them is they're doing around 180,000 tons today. They're bringing on new projects like Monteverde Growth. They've got Santo Domingo, which will eventually come online as well. But there's a path line to go from 180,000, 185,000 tons today to around 400,000 tons by sort of 2030, and then push that up even more so. And the reason we like it in particular is those key growth assets, so Monteverde, Santo Domingo, and Sierra Norte are all sort of 30 to 40 kilometers away from each other. So the actual capex to upgrade existing infrastructure, like for example, like water desalination, that sort of thing is actually pretty minimal for a much higher output when you can sort of push that production growth coming through. So Capstone Copper would probably be the top pick on our end, at least domestically in terms of copper exposure.
Last one, I'll shut up. Last time we spoke was you didn't like South 32, but it's got a sprinkling silver, sprinkling of copper, a little bit of aluminium.
South 32 is tough. I think on one hand, you need the stars to align on the macro.
Yeah.
And they've got such a mishmash of different commodities that it's not really happening. I think the closure of Mazaos, the aluminium smelter, is going to be locked in stone pretty soon. I don't think they're coming to an agreement. I mean, at the moment, basically, the Mozal smelters in Mozambique, and there was a complicated arrangement where they were getting their power from, I guess, the government electricity company, which is hydro-powered, but they were getting paid by the South African electricity provider, Eskom, and Eskom have turned around and said, we're losing money on this deal. Well, the smelter's not made anywhere near the cash it needs to, so it looks like that'll shut. So you've got that problem as well. And I also think they're going through a CEO change, so it's hard for us to get on board and excited at the moment when I think the underlying assumption is that the new CEO will come in and clean house, whether that's sort of selling off assets, shutting assets, or carving out different parts of the business. I think you probably need to see where that strategy lies, because South 32 has run a net cash balance sheet. They bought back billions of dollars worth of stock, and it's had no impact on how the market perceives those assets in that company. So while I think they've done a good job with what they had. The stars haven't aligned. I think it's probably still a little bit too hard at the moment.
With silver, it's outperformed gold this year. Haven't really heard you speak about it much. The silver to gold ratio, from my understanding, still looks pretty good. Then you've got huge solar projects like the Sun Cable project that I think should be, a big user of that. What are your thoughts there? Do you see that's continuing this performance in the next year?
Looks like silver.
Sorry, whether the silver outperforms gold next year?
Yeah, whether this performance continues, considering the ratio to gold, and just with the big solar projects that are set to kick off, obviously, large part of that being silver.
Yeah, I mean, I appreciate that the silver to gold ratio is blown out a little bit, but much like that chart that I had of sort of the Goldman Sachs index versus the S&P 500, like you sort of need I think you need a why or a trigger for like why that ratio should close, and that may well be solar demand, but I appreciate there's some big projects out there, but the rate of growth of solar globally has actually rolled over pretty hard since 1st of June, where China cut their solar and wind subsidies, and obviously the US has cut their subsidies as well. So it is still growing, quite strongly globally, but perhaps not as fast as what it once was. But I suppose the biggest challenge with silver is just the quality of the companies, so the pure players, because obviously a lot of silver comes via is a byproduct of lead and zinc production. But yeah, some of these projects, like the ones that I think it's Sun Silver and a few others, like I'm just a little bit wary on the development economics of those things. And yes, that while there might be a sort of a supply demand argument for silver on the industrial side, on the precious metal side, silver is actually not an official reserve asset that central banks can buy, whereas gold is. So I think that that's probably why, or part of the reason why gold's outperformed silver in recent time. Well, for most of the last couple of years, and that ratio is blown out to where it is. And unless silver becomes denoted as an official central bank reserve asset, then I suspect that sort of disparity in demand drivers might stay for a little bit longer. All that said, I mean, we do have some silver in the portfolio, but it sits as a subset within our precious metals, the bulk of which is gold.
You just have a bit more gold mining, Alkane in central west New South Wales. It's a bit of a pet of mine, but I believe it's got quite a large resource, and the owners are long-standing gold producers because they ran the Parkes mine all the way through. So do you guys look at that at all and have a view?
So I didn't catch the company.
Alkane.
Oh yeah.
West, yes.
So I wasn't aware they've got a silver asset. I thought they just had Tomingley and
No, I was saying gold. Back to
gold.
Right. Back to gold.
Yeah, sorry, my mistake. Yeah, I have had a bit of a look at it, and I think that the merger that they did with that I think it was a Canadian listed company sort of made a bit of sense. We're not a holder at the moment, but is there anything in particular why not? Well, no. It's just trying to find room with it in the or for it in the portfolio versus what we've already got.
No, I've got a second one, and that'll do me. In relation to the rare earth space, I understand is the offtake agreements one of the very important things with the various ores or metals you produce, that I understand that they need to be very specific in relation to the quality and the quantity and so on. And so the execution of your production is really important. And I understand, or I'd like you to tell me, is the contract just as important as the product that they get out of the ground? So the large companies coming forward and saying, we want so many kilos or tons to this standard. Is that a big driver in the success of these companies?
Yeah, massively. So depending on what products you're going to produce and how much subsequent refining is still required to produce a usable, end product, that's going to heavily weigh on the payability of your offtake. So a lot of these rare earth projects are looking at payabilities of about 60% or thereabouts. I mean, sometimes a little bit more, sometimes a little bit less. So, that's 40% of the metal that you're pulling out of the ground that you're not getting paid for because of the costs involved in refining that product to something that end users can adopt. So it is important, but it sort of cuts both ways. Like, yes, you do need to be able to sell your product, but an offtake agreement is effectively a liability. It's like you're obligated to sell your product into that agreement. So yeah, it's a bit chicken and egg in terms of finding the right agreement versus I suppose sterilizing yourself for interest from other parties. And if you can get your financing away without, I suppose, having to lock up all your production via offtake, it's probably probably a better strategy. Because the longer, I suppose, the longer you can hold out, the better. But yeah, like the idiosyncrasies around the nature of your product and the quality of it and how much it costs to refine are all important.
Since excuse me, since July of this year, how's the fund dealt with, I guess, the most recent rise and fall of commodity equities and sort of the turbulence within the markets? And then probably the second question would be, do you believe that we are still at the early stages of a super cycle, which I think you guys sort of answered, but I'll put it back to you.
Yeah, I suppose since July things have been going very well, as per the chart. I mean, this month as we sit here today, we're down a little bit, but not no more than the market and possibly a bit less. Unfortunately, one of the frustrating things is, I suppose, one of the part of the reason for the choppiness this month has been a lot of the momentum in AI stocks sort of easing somewhat. But that AI thematic had been flowing throughout, uranium names and other energy names as well. So, even though I'd argue the fundamentals of, something like uranium aren't anywhere near as, overcooked as they are for some of these AI stocks, you still get a downdraft when the Magnificent Seven, catch a bit of a sniffle. But be that as it may, the fundamentals should shine through and those sectors should re-rate. But how do we handle it? Well, yeah, we cash levels are probably a bit more elevated than they now than they were in certainly June, July. I have to go check the chart. Our industrial mix was trending down, but I think it's ticked up a little bit in October. Yeah, you can see, in towards the top left of the chart in yellow and grey there, our industrials exposures were increasing through September and October, just to take a little bit of beta out of the portfolio and pivot to stuff that wasn't as exposed to, I suppose it wasn't as full of momentum money, I suppose, as the gold stocks and a few of the others, which you can see from there we took some profits in gold through from September and into October. So that's sort of what we do, and it doesn't ensure a positive return every single month, but overall through the journey it's pretty good in protecting that downside.
Yeah, you also had me at hello too, but just you seem to have got out of some commodities at a good time, and the thing with commodities is always when the price goes too high, you get substitution or something like that. We saw, and the other thing is when China gets involved, profits disappear. We saw obviously nickel, cobalt, lithium, although that's making a comeback now. Any in particular, obviously, you've mentioned a few of your key ones. Any in particular where you think there's a risk of that happening? And then secondly, if you can touch on your uranium, because you're going to talk about it, I think you didn't.
Oh yeah. I don't see I don't think there's any commodity at the moment that really stands out as being, massively frothy and sort of at risk of a pullback. I mean, I mean, copper. I mean, lithium's sort of a bit of a bounce, but it's only just got off its lows. Copper is at close to all-time highs, but we've talked through that, and the structural sort of challenges for that commodity for the foreseeable future, I think, will keep that price reasonably well supported. So there's not one particular area we're worried about. I mean, I suppose one that's constantly bemused us as the price has held up a lot better than we thought it did was iron ore. And yeah, looking at some of the fixed asset investment data coming out of China just today, and coupled with Simandou about to ramp up, I'm still amazed that price is still sticking above $100 a ton. But yeah, time will tell. But to one of your questions, like how do you avoid that? It's doing the modeling. Like you need to, if you're only holding on to sort of qualitative assessments of value, then it's difficult to pick a point where things have just got too expensive and ridiculous. So I suppose a few points where we've got involved in a commodity, but then realized we made a mistake and got out of it. You can see on the chart in front of you. So March 23, we got all excited about graphite. For a while, we thought it was going to be the next battery metal to go on a big run. But exactly as you point out, China got involved in this space in a big way, and the synthetic graphite production grew far more than what anybody was expecting, and that rally was over before it began. But we saw it and made the adjustment quickly. So, that didn't really, despite the fact we were wrong there, it didn't really cost us anything because we realized we were wrong quickly. Similarly with lithium in late 23, I mean, we thought that it might have been ready for a bounce, but again realized we were a bit too early and exited, and that saved us quite a bit of pain, particularly relative to some of the other commodity funds around the place that probably stuck with lithium a little bit longer than they should. But yeah, I suppose if that answers the question, good. Otherwise, if there's anything you want a bit more color on, happy to provide it.
No, that's great. And also uranium.
Oh yeah, sorry. I need to pull that this other slide. I gave a presentation to a mining conference over in Perth last week about this, and what we're seeing here in nuclear is the I suppose the realization of just how good this technology was, or how much it had achieved already, like back in the 70s, and some of that technology is being picked back up again and had a bit of life breathed into it. But I suppose the main point from that presentation was that back in 1974, I think it was, the United States was connecting one nuclear reactor to the grid per month. So they banged out 12 in that 12-month period in 1974. And so, it was getting cheaper as the build costs were as the building process was getting faster, the supply chains were well established. And it just begs the question, why on earth did we ever pivot away from this sector? Because the build out of reactors rolled over in 74, 75. This was half a decade before 3 Mile Island in 79. And then, of course, Chernobyl in 86. And the story goes that there was a massive lobbying campaign, both from the US government and the oil and gas industry, to discredit nuclear, because there was tangible signs that nuclear was about to make the jump from stationary power generation to mobile power generation. So there was prototypes of nuclear planes and nuclear trains and even nuclear cars were doing the rounds. And that seems fanciful at the moment, but just consider that, like, back in the 70s, you already had nuclear submarines and nuclear boats going around the world. You had nuclear batteries powering the Voyager 1 and Voyager 2 satellites, which have been running for about 47 years now, and they've still got 20% of their charge left. So it was understandable why the population or the business community thought that jump to mobile power generation was about to take place, and that was a direct threat to oil's market share and its supremacy as the sort of core driver of the world economy. And so, the nuclear industry was undermined savagely by both government and industry, and through funding various lobby groups and whatnot. And it's all this is sort of well documented. It's not speculation. It did indeed happen. However, now we're in nuclear renaissance 2.0. The oil and gas industry is much diminished from where it was in the 70s, and that technology that had already been evolved and still exists in the military sphere today, that will be replicated in the civilian space. And I just think it's going to be impossible to compete with once it gets going. So yes, it's a few years ahead of us, but I think last I checked, there was something like 40 different companies in the US progressing plans for small modular reactors. So like in any startup industry, there's going to be a bunch of failures, but there will be a few successes that become absolute giants. And the demand for uranium will tick up quite materially as a result. But yeah, it's something that we've got some fingers and toes in for sure. But I don't want to have too big a swing at it yet, because it is a small commodity. It is quite opaque. It is volatile, but the technology and the energy density which powers it all, I think, is beyond question. So yeah, if that's a bit of an arm wavy type answer, hopefully that provides a bit of colour of the way we're looking at it.
Probably add as well that we do think I know Heinze thinks the same, that there's a material uptick coming in prices. I mean, a lot of the Western utility names are going to have to recontract because those inventory stockpiles, which they build up after Fukushima, are sort of finally running down. So they're going to come through to the market and sort of they need to recontract 28, 29, but they're already starting to slowly have those conversations today. And then you've also got the situation where Kazatomprom, which is, I guess, the Kazakhstan-based producer, well, Kazakhstan's 40% of global production, and they're more and more getting caught in between Russia and China as a landlocked nation, who in turn are trying to dominate bring their own sort of nuclear supremacy through. So I think you're seeing a lot of the Western countries realize that they might not be the most reliable supplier, and you're having to look abroad elsewhere. And I mean, we own NextGen, who obviously have got the real project over in Canada, it looks fantastic. Numbers stack up really well. We're just waiting on sort of like that federal permitting process come through. But I think you're going to see a swing that way as they look to sort of take equity stakes, be happy to pay for the capex to just get hold of that offtake. So I think that scarcity could come through as well.
Actually, yeah, just adding to that, I wouldn't be surprised, and I've had rumors and stuff and speculation about which critical mineral or commodity the US government might act to support next. I wouldn't be surprised if it is uranium after rare earths. Time will tell, but they are, nuclear is going to be their fastest growing means of power generation going forward. It's the one of the few things that has bipartisan support in the US. I wouldn't be surprised if they do something along those lines to make sure US production is increased. But yeah, we'll see.
You spoke a little earlier about the challenge of the availability and cost of the energy input for mining production in the country, in Australia. How about other inputs like labour, regulatory approvals, that sort of thing? How do you think about the geographically investing in a mining business here versus elsewhere when you consider those inputs?
Yeah, it's a good question. I mean, in Australia, I think labour costs, reasonably stable at the moment. I mean, there's some concerns that we might see a little bit of inflation next year, but that's all right. On the energy front, remote power generation is something that we do very well in Australia. So it's very different to the problems that the grid deals with, because any mining company can optimize their power mix themselves because they build their own little microgrid, and they can pick and choose what sort of energy mix that they want. And the vast majority of them optimize for cost. The ones that don't, so Liontown and Bellevue, have ended up paying materially more for their power than they needed to, but that was their choice. But on the permitting front, it is a big problem here in WA and also Australia wide. In the time that it takes to get a mine permit is ridiculous, and it's not just my opinion. It's something that that was echoed in conversations I had with South 32, First Quantum, and I think I bumped into somebody from Rio. Just all saw one after another just in September, and I asked, if you had to pick a geography that develop a new project in, would Australia make the top five? And they all said no. And for South 32 in particular was very complimentary of the US, and so was First Quantum. So I think you will see capital move from Australia to the US because it's just easier to operate and get things done there. And obviously the oil and gas industry is already, a long way down that path. So yeah, and it's going to be interesting how valuations acknowledge that fact. Like, it will take time, and there will be I think a strong sort of ASX bias to Australian projects. But over time, as if US projects start getting up and funded and developed, faster than they are here, then they should start to trade on a bit of a premium relative to the Australian ones, which would be unusual. But yeah, I think it's that's where we are at the moment.
South 32 went through hell and back getting sort of like Worsley over the line. I think they originally told it would be maybe 12 to 15 months. It took nearly 3.5 years. And then there was just like further back and forth. And in the meantime, the share price got kicked around because that's the key economic driver of South 32's earnings. And they're sort of just inside this purgatory period. I think also when we think about countries, obviously normally preferences for ASX listed, up to 20% can go offshore. But in general, you're very cognizant of where those mining jurisdictions are. So the tier one mining jurisdictions for a lot of these commodities have sort of been exhausted. And that's why I think the prime example, I guess, on the ASX would be Rio's gone through God knows what amount of pain for Oyu Tolgoi with the Mongolian government. But that's because it'll be the world's third biggest copper mines. They've just had to keep dealing with changing governments, handouts here or there. I think that's something we're always sort of like wary of, depending on where those mines are. Obviously listed in tier one mining jurisdictions, but you do have to be aware of where these mines are situated and sort of any fluctuations with government, royalty, tax regimes, all these sort of things. Because Sam mentioned First Quantum, they operate the Cobre Panamá mine. That's 5% of Panama's GDP. New government came in, populist movement, took the mine offline overnight, and it hasn't produced anything for 2 and a bit years now. And that's